The stock market has done amazing this year. It's really done incredible. In fact, if we look at the overall major indices, the things that we track the overall stock performance, we have the QQQ. It's up 33% year to date. Just so far this year, up 33%. Now, this is the QQQ. It's more volatile. It's known to take off like a rocket sometimes, but 33% is a very, very good year, especially when there's so many people predicting that 2023 would be a horrible year in the stock market. Well, here we are. The QQQ, all these tech companies, the NASDAQ 100 up 33%. We have the S&P 500, the major benchmark that everybody really compares themselves to. This is up 12.31%. That is great performance. The average for SPY is somewhere around 7 to 10% for an entire year. We're about halfway through the year and we're up over 12%. So this has overall been a pretty awesome year, but it hasn't been that amazing for every type of investor. In fact, there's a certain category of investor that has been missing out on this year's gains, and that is dividend investors. Take your pick. Look at any of the major dividend ETFs like SCHD, which I believe is the most popular one by far, and it's not doing well. It's down 5.3% year to date. Now, so far, it's probably paid around 2% in dividends, so it's down around 3%, but it's still down 5.3% on a year where everything else seems to be going up. Now, this isn't good for SCHD or other dividend ETFs. They simply haven't done as good, and that's something that I think is worth discussion. After all, being down 5% is not such a big deal, but being down 5% when the other major indices are up double digits is a pretty big deal. The relative underperformance of SCHD and other dividend ETFs is really dramatic here. So why is that? Why is SCHD and other dividend stocks in general underperforming the broader market? We're going to be getting to the bottom of this in this episode. Now, before we jump in, I must say that I have personally been a dividend investor for a long period of time. A dividend investor in the form of passive income, meaning that I don't look specifically for dividends. I look for ways of earning money that I don't have to really work for it. That's what I've been overall looking for. Dividends is a disbursement of cash that a company pays after it's done all of the rest of its obligations. They have extra money sitting around, they return that money back to the investor. That is a dividend, which is a form of passive income. I have a portfolio here called the passive income portfolio because ultimately my goal is to grow this to a big enough size and to be able to live off of the fruits of this portfolio, the passive income that it generates through dividends, through interest payments from bonds if I ever own those. Either way, I want this portfolio to be able to subsidize my cost of living. That is passive income. That is dividend investing. And dividends are a very direct form of payment, so they're easy to understand. A company earns money. They have excess cash flow, more than they can use effectively, so they return that back to the shareholder. You, the shareholder, receives that payment as a dividend payment, and you can do whatever you want with it. You can take the cash and you can use that cash to buy more companies. That's what Buffett has done his entire life. That's a big part of the entire snowballing effect. So we have dividend payments here, and we have ETFs that gather together lots of dividend paying companies. One of those, again, is SCHD. This is my personal favorite choice in terms of dividend paying ETFs, SCHD. But it hasn't done as well as it historically performs. Historically, this ETF pays out above a 4% dividend yield while keeping up with the S&P 500. And that is a difficult task to do. In fact, SCHD has historically accomplished this difficult balancing act of having a high starting yield and good total returns at the same time. It's really done a phenomenal job. So it's drawn a lot of dividend investors into the CTF as an easy way to get your passive income, to get your dividend payment while not sacrificing capital appreciation. This is the perfect mixture, and it's attracted a lot of investors. In fact, there's entire communities on Reddit, ones like the dividend community, where there's so many posts and so much discussion about SCHD that it is virtually endless. It's basically a cult-like following for the CTF. So many people are putting their entire life savings, all of their investments into the CTF. The following that this ETF has is extremely enthusiastic and in some ways cult-like, similar to what you see in Cathie Wood's ARK Innovation ETF. But while ARK Innovation is full of companies that are highly speculative and in many cases don't make a lot of money, SCHD is more of the mature version of this. It's no nonsense. There's no speculation. Every company in it makes a lot of cash flow. They're real businesses producing real products that make real money. So the SCHD investor is one that's looking for a high quality ETF, one that diversifies money, and one that invests in companies that are non-speculative, especially ones that pay out a dividend income on top of good capital appreciation. It's a reasonable approach to investing. And after many people have put a lot of money in this ETF, we're now having some question marks because it seems to be faltering. It does not seem to be keeping up with the rest of the market. Now, what I believe is happening, and the reason that SCHD is underperforming, I believe is more of an overall market dynamic than anything specific to this ETF. And I think that this article that I'm going to be referencing from the Wall Street Journal, I think this really nails it down. Even though this doesn't talk specifically about SCHD, let's go ahead and just apply some of the logic of what it's talking about here. The article starts off by saying that major indexes have overcome a series of challenges to power higher this year. Most of them, the major ones, except for dividend ones. But some investors are worried that this performance rests on just a few heavyweight stocks. And this right there, this is where it gets to really the bottom of the issue. The performance of the index resting on a few heavyweight stocks. The S&P 500 has climbed nearly 12% this year and is poised to enter a new bull market after rising almost 20% from the October trough. Most major indexes in Europe are up more than 10% in 2023, with France's CAC 40 among those that are hovering around all-time highs. So overall, a lot of these indexes are doing really well. The performance has surprised asset managers and begin the year on the sidelines amid concerns about the trajectory of interest rates in the global economy. I think these asset managers are fools that are putting their money on the sidelines. I think they need to be invested. Staying invested turned out to be a very good decision this year. Indexes have shrugged off a banking crisis, a debt ceiling standoff in the US, and worries about the recession in Europe. Again, not surprising. If you're invested in the market long enough, we shrug off everything eventually. We shrug off world wars. We shrug off pandemics. We shrug off everything. That's how the market works. We overcome challenges. But it continues on. But for some investors and analysts, things don't look so cherry below the surface. And this is where we get into other ETFs like SCHD. Market breadth, which reflects how many stocks are participating in the rally, has narrowed, signaling possible trouble ahead. Quote, if you look at the S&P 500 index level, you might be fooled into thinking that actually the market is doing really well, that activity is strong and profit growth is in full recovery mode. But that would be a quite incorrect reflection on what's going on under the surface. So looking at the market right now, your assumption would be things are going well. The overall market's recovering. Things are going up. Earnings must be growing. Things must be doing really well. But they're saying that that's the incorrect conclusion here. The past few years have been periodically marked by US technology stock dominance, but the grip has tightened recently. 8 of the largest tech and growth companies in the US, Alphabet, Amazon, Apple, Meta, Microsoft, Netflix, Tesla, and Nvidia, now account for 30% of the S&P 500's market capitalization. Let me put some emphasis on this. These companies right here make up 30% of the US stock market. The S&P 500, the 500 biggest companies, 30%. Now, I have to say, I have not been surprised by this. In fact, I've came out with videos saying that big tech is perpetually undervalued because these companies, they're not just big market caps, they're big revenues, they're big earnings, they're big cash flows. Apple and Amazon and Meta and Microsoft and Netflix and Tesla are dominant. How many times have I said that Amazon is dominant in online retail, or that Apple's completely dominant in making user devices, or that Netflix is going to dominate in streaming? I've repeatedly said that these companies are going to consolidate both revenues and cash flows and market position, and they've done that. and they're being weighted higher and higher in these market cap weighted indexes. So now these 8 companies alone make up for 30% of the US stock market if you're judging that based on the S&P 500. That's up from about 22% at the start of the year. So they've actually grown their weighting dramatically, 8% from the beginning of the year to now. One sign of a narrowing breadth can be seen in how the S&P 500 has fared this year compared with its equally weighted counterpart, which gives equal sway to every company in the index. So let me just go into this for a minute. There are 2 ways to form, well, there's lots of ways, but there's 2 main ways to form an index. You either have equal weighted, where you have, let's say, 100 companies and each one occupies a 1% allocation. No matter how big the company is, you just weight them equally in the index. Equal weighted index. Then you have market cap weighted index, where every single company occupies a percentage allocation that's based on the market cap of the company. So if the company grows in market cap, it grows a bigger allocation percentage of the index. Those are the 2 main ways. And what's happening is the market cap weighted indexes are far outperforming the equal weighted ones. Now they say compared with the traditional index's 12% gain, that's the normal S&P 500, the equal weighted version has only added 1.8%. So the performance differentiation between the equal weighted and the market cap weighted is massive. This is the largest ever outperformance by the S&P 500 on a year-to-date basis, according to the Dow Jones Market Data Analysis. So the spread between equal weighted and market cap weighted has literally never been bigger. And this is important to note that this is rather unique. In fact, over history, since at least 1990, the equal weighted S&P 500 index typically outperforms the market cap weighted index. So this isn't something that's always happened. This is new. Look at the most recent year. We have right here, 2023, this massive positive spike of outperformance. That's unusual. Look at all the last years. All these ones going negative throughout the chart are years where the equal weighted has beat out the market cap weighted. So this is something unusual where only a couple huge companies are lifting up the entire index, pulling up the performance of the market cap weighted index and leaving all the other stocks in the equal weighted indexes behind. So unless you are fortunate enough or lucky enough to select those specific stocks, the large market cap weighted ones that did particularly well this year, your performance has probably been really poor. Now, there's other indicators they look at as well to show the extent of this issue of concentration into a couple huge companies. Other indicators of market breadth have also flashed warning signs. The share of the S&P 500 stocks closing above their 200-day moving averages fell as low as 38% last week. The market is generally considered healthier when more stocks are rising together. And history shows that the broader rallies are typically more sustainable. So basically, when we have a market rally that's only driven by these handful of massive companies, that's less sustainable than when we have a market rally that's driven by overall earnings in the broader economy and all of these companies doing really well together. Right now, we have a highly concentrated rally driven by a handful of companies. Not very sustainable, historically speaking. In contrast, limited breadth can often precede a downturn. S&P 500 returns over the next month, 3 months, half a year, and year tend to be negative when fewer than 48% of stocks are trading above their average over the past 200 days, which is what we are doing right now. So knowing that this entire rally is being driven by a handful of companies, we can look at our portfolios and simply assess if that's the reason they're doing well. When I look at my portfolio, the passive income portfolio, for example, I can filter by the year to date here. So we have the year to date right there. We're just looking at 2023. And I can see where the outperformance is coming from. So far, I'm up around the level of SPY, about 13%. And we have the part of my portfolio that's doing well and the part that's not doing well. The part that's not doing well is SCHD. The diversified dividend paying ETF is down 5% year to date. So that has not been a good position. We also have industrials. These dividend payer monopolistic companies have not done well. We have the consumer category. This is doing okay simply because of Costco. I have a huge holding in Costco and that one's really kept up. The restaurant category, this one's doing pretty good as well because I bought Texas Roadhouse on a dip. That one has done really well. We have the other category, real estate. not doing well this year, only up 2%. We have the finance category not doing too well this year either. S&P Global, MasterCard, and Intuit only up a couple percentage, dragging behind the QQQ or the S&P 500. And then we get to one category here that looks slightly different than the rest of them. The tech category, up 39% year to date. In aggregate, up $29,600. In the tech category, I am heavily overweighted into two companies, Microsoft and Apple. Microsoft being up 36% this year, and Apple being up 43% this year. $15,000 and $14,000 with these two companies alone. So when I look at my portfolio, it shows what they're talking about. The overall performance this year, the huge majority of it, is simply because I had Apple and Microsoft in my portfolio. Had I not been heavily overweighted in these two companies, I would be basically flat this year. I'd have overall no performance. Luckily, and again, I think a lot of this comes down to luck, luckily I had these two companies overweighted heavily in my portfolio. And in the story fund, it looks a bit similar, but the story fund is more focused on big tech. A lot of people criticize me for investing heavily in big tech. They say, why don't you just buy the QQQ? The reason why is I think that big tech is the best part of the QQQ. I think that there's going to be outperformance more by the bigger companies than the rest of the QQQ. When I look at the year-to-date performance of the story fund, it's up 38%, beating out the QQQ, beating out the S&P 500, up $39,900 so far this year. And the reason why is because of how overweighted I am into big tech, the companies that they're specifically outlining. Amazon is up 40% this year. Netflix is up 39%. Google's up 41%. Microsoft's up 36%, Adobe's up 20%, Salesforce is up 62%. These companies have done phenomenally well this year, and they comprise the huge majority of my portfolio. So this year has been lucky for my portfolio. I've been concentrated into these companies that are doing really well, but a lot of investors are simply putting money into SCHD or into a diversified dividend ETF, and they're being left behind. And the question that you may be asking now is, knowing that this rally has been driven by only a handful of companies, should you change your strategy and now dive headfirst into these big companies? Should you be putting money into Nvidia or into Apple or into Microsoft? That's a question I want to answer right now. To put it simply, I think the answer is no. And the reason why is I think that that's a bad strategy to follow what recently just did really well and what's recently driving the market outperformance. If we were to do that, we'd be buying companies like Nvidia, which trade at a $1 trillion market cap at a 44 PE ratio and basically no trailing free cash flow yield. This is a very dangerous proposition. Could Nvidia keep racing up? Could it go to 2 trillion? There's a possibility. But more often than not, these stories don't end happy for these investors. When you're chasing returns, when you're excited about buzzwords like AI, it doesn't end well. Even companies that I'm invested in, Apple, for example, I'm not buying more Apple right now. It's gone through a massive run. The free cash flow yield has gone down from 4% to 3%. The PE ratio is in the higher end range of the 25 PE. I think Apple's still good. I think it will do well. I'm not selling my position, but I certainly wouldn't be piling money into it right now. The time to do that is when other investors are not enthusiastic about the company. Right now, investors are incredibly excited about these top companies. They're getting a huge bid. Many of them are going up to very high valuations. We can take Microsoft, for example, as well. Up to the higher end of a 27 PE ratio, a 2% free cash flow yield, when treasury rates are what they are. Microsoft, I've talked about. I think it's an incredible company, the poster child for the best fundamentals of any company. But it has recently gone up so much that I've stopped adding to this position. I'm now building up other companies that haven't got a bid. I'm building up MasterCard. I'm building up S&P Global, Intuit, the railroads, other companies that aren't doing well. So when I look at this, I don't think it's time to give up on SCHD, to give up on other strategies, and to pile into the biggest companies. And based on history, based on this chart, the relative unique outperformance of only a handful of companies is something unusual. If I was to guess, the next big rally or the next market going up will be driven by the overall market. It'll be less concentrated into only a couple of companies because history shows that to be the case. All the times where this is in the negative, that's times where the market equal weighted index has beat the market cap weighted index. So SCHD being a market equal weighted index It means that you're not doing well right now, but you may just have to wait a bit. Don't have FOMO. Don't give up on a well thought out investment strategy just because of 6 months of underperformance. That's not how investing works. You're not going to do really well during all time periods. Now, if you like this type of content, make sure to subscribe to the channel. If you want access to Qualtrim, you can sign up today and get a 30-day free trial. It's actually until the beginning of next month. So try it out. There's no risk, nothing to lose, and I think you'll love it. That's all for this time. I'll see you in the next one.